Hey everybody, welcome to Cordant's market update for the third quarter of 2023. Going to do a little bit of a different video format this time to get it out to you in a more timely fashion, but going to cover the same thing. So we're going to look at what happened in the markets in the third quarter and then take a look at some of the common questions that we're hearing from people right now. So first of all, just briefly take a look at the performance over the whole year. As you can see, year started out pretty well. Second half of the year has not gone as well. The third quarter is no exception. Things were down pretty much across the board. U.S. market, international market, and the bond market was down in the third quarter as well as interest rates really went up in the third quarter. Crossed the spectrum here, U.S. stocks down, small value being the best performer there. International markets, value stocks actually up a little bit. Small cap stocks next in line, but down across the international markets. Emerging markets, small cap stocks actually up there. Value down slightly, and then growth kind of bringing up the rear in the emerging markets. So theme kind of developing, things down across the board, third quarter being a pretty tough quarter. Commodities, kind of the lone exception there. Commodities up a little bit in the quarter, but as you can see, with inflation coming down, commodities have been down year to date as well. So that's kind of the very quick overview, and obviously things do not feel good right now. I did want to start off with this as kind of a reminder. The first client question that we're hearing primarily is just, things aren't feeling very good right now. This is reflected in some of the sentiment surveys. So this is the consumer sentiment survey with the S&P 500 returns in here. And I think the main point is oftentimes when things feel the worst, actually from an investment perspective, those are some of the better times to be invested. So if you're looking at this chart, the average consumer sentiment across time going back to 1971 was 85 on the scale. We're sitting at a 68 today, so below that. And up, however, a little bit from kind of the lowest sentiment that we've seen recently here about a year ago. Main thing to note here is when consumer sentiment is high, forward returns over the next year from the market tend to be lower. So during the 9 peaks, average returns still positive, but 3.5%. Versus the troughs, the 9 troughs have been an average return of 24% over the next 12 months. So I really like this quote from Dr. David Kelly at Morgan Stanley. He said investors should focus on fundamentals and valuations rather than how they feel about the world right now. And I think this chart really sums that up and is oftentimes true. So first thing, just a bit of context. I know things don't feel good, but oftentimes that context is helpful to keep in mind. Next thing I wanted to look at is this question in various versions is, why don't I just put my money in the bank? I can get 5% or something like that on my money. I thought this was a pretty good way to look at it. Again, this comes from Morgan Stanley and some of their research. But it looks at the 6 periods of hiking that the Federal Reserve has done, the last 6 periods of hiking. And really what you can see is, again, if you look out 12 months, when the Federal Reserve stops hiking, this actually becomes a pretty good opportunity going forward for investment returns. So while you can certainly lock in your money at the bank for 12 months or something like that and get 5%, you're missing out on a couple things. That's a short-term sort of return. Over the next 10, 20 years or whatever, you would expect the market to do better than that. And there's no guarantees that you're going to get that 5% on your money in the bank after that locked-in period. But even if you look at it from a short-term perspective, over the next year, the odds look pretty good. Once the Fed stops hiking, returns tend to be pretty good across some different asset classes. So this data is looking at money in the bank, basically CDs, compared to bonds, compared to high-yield bonds, and compared to the market. And just focusing in on bonds and stocks, over these periods, the average bond return is 14%. The average stock return was 20% over the next 12 months compared to money in the bank. So really think about this as an opportunity cost. Yes, you can lock in your money in the bank at 5% today, but you might be missing out on a big opportunity in your portfolio if that was a change that you made. Next question that we get a lot of is just bonds. Why bonds? They really performed poorly lately. Why would we own bonds? So yes, true, they performed poorly lately. So here what we're looking at is the world stock market in green, the bond market in blue, and then a shorter term bond market in orange. So the 2 points that I wanted to make on this slide is yes, bonds have performed poorly going back to the beginning of 2022 when interest rates really started to go up. You can see bonds down about 14.5% compared to the stock market, down a little over 11% over that period. They did, in 2022, when the stock market really dropped, they were down less, kind of helped a little bit, but still obviously down over that period. The thing I'll point out here is, shorter term bonds are going to be less sensitive to interest rates. We've held more of these in client portfolios, been closer to the orange line than the blue line. And so not all bonds have showed as much of a loss as some of the longer term bonds. And so, shorter term government bonds have been down slightly over this period. And that's for our clients, for our portfolios, we've tended to be closer to that. So not all bonds are created equal. But question remains, bonds going forward, does it make sense? So a couple things to look at here. One is just yields are a lot higher on bonds than they were, say, 2 years ago at the end of 2021. We're looking at here yields anywhere from 3 month down or out to 30 years. And so what you can see is just across the board, yields are higher. So forward-looking projections for bonds would be more attractive. Yield is where you're going to make most of your return on bonds. And so it's simply more attractive as yields have risen. So painful to get there. There's going to be some losses associated with getting rates up, but going forward, actually, the higher yields should mean higher expected returns going forward. So that's one thing. The other thing to look at is basically the notion of higher rates make bond math look more attractive. So bond math is essentially if rates go up 1% or down 1%, what's the impact on returns? And what you can see across the board right now, the way we're sitting, is a 1% fall in interest rates make bond returns pretty attractive across the board, but even a 1% rise. So I don't know that anybody's forecasting something like this, but if rates went from 5 to 6%, say, you can see across the bond universe, because of these higher yields, it actually doesn't get a lot of the bond instruments, except for maybe longer term bonds, 10 years and 30-year bonds. You're still having some positive returns, even if rates went up more. So simply the bond math is more attractive now as interest rates have gone up. The next question we get is about a recession. Obviously, things don't feel good right now. Markets are down, markets are volatile, and everybody's worried about what's going in the economy. I always like to check in on basically the different variables that the National Bureau of Economic Research looks at when they're determining a recession. And really you can see where things are currently in the blue bars, kind of in the middle here. And across the measurements they look at, kind of the 6 different measurements, only one is down, the rest of them are positive. And so yes, there's some pain points in the economy, things are bumpy, there's a lot going on in the world, obviously, but purely from an economic perspective, things are still chugging along. Things have slowed down, but things are still chugging along. So always worth paying attention to that. And then the last question that we get a lot of is, okay, given all this, where are the opportunities right now? So want to kind of step through on the equity markets, a couple things. So in the US market, I'd say the opportunities tend to be in some of the smaller stocks and in value stocks. And so what you can see on the chart on the left is the areas of the market that have done very well recently, kind of the big mega cap growth firms, they have done well, but they are expensive. If you strip those out, the market is much cheaper. That would be the green line versus the gray line on the left. On the right, growth versus value, you can see value by definition is always going to be cheaper than growth, but even compared to its own history, value is cheaper relative to growth than it has been over a lot of the period over the last 25 years. And so if you're looking at which areas of the U.S. market are attractive, it's smaller stocks and value stocks. And we can see that on the next slide as well. If we look over here, if we look at the lower right, you can just see from growth stocks down to large growth stocks down to small value stocks. Small value stocks tend to be the least expensive out there. And that's where we position client portfolios, tend to be smaller and more value-based. When we look at international stocks, obviously opportunities there as well. On the international front, again, relative to history, the international stocks tend to be cheaper than U.S. stocks for good reasons, obviously. But relative to that history, the comparison between the two, international stocks are pretty darn cheap. And that shows a bit higher dividend yield as well. So in terms of opportunities, there's opportunities outside of the U.S. As markets outside of the U.S. Tend to be less expensive right now, and also gives some of that currency hedge as well. If U.S. dollar depreciates, foreign currencies go up, that's going to help in terms of foreign investments as well. So those are the main questions that we're hearing right now, and thoughts, comments around that. As always, would love to hear any other questions, concerns that you have. Reach out and we can address them next time, or reach out to me directly, and I'd be happy to have a conversation. Okay, thanks. Hope this is helpful, and talk to you next time.